All right. Welcome, everyone. Jacob Blackett here with Dave and Glenn Gonzalez. And we're here talking about Cobble Hill Apartments tonight. I'm looking forward to getting a little bit more into detail. We're down here in San Diego. Actually, we were just talking about the fact that the three of us met over a year ago at a real estate event. Actually, the same real estate event that we're at this weekend.
In Florida.
In
It was in Florida, yeah.
Down in Florida. So that's kind of what we'll be talking about is the relationship here, why we're working together, what's working in this partnership, and of course, the current deal, Cobble Hill Apartments. So Dave and Glenn, you guys want to just take a quick second to let the Holdfolio crowd know a little bit about yourself?
Yeah, and thanks for doing this for us. It's really exciting to be working with you, and we appreciate you. Cool thing is we have a lot of like minds here, so that's what really made this synergy great. Cobble Hill came to us by way of a relationship that we have with Marcus Milchap. So Al is a broker that we've used up in DFW to sell some of the assets that I own. We've got a few thousand units, and he took part of those and sold them for us. And due to that relationship, there were 3 apartment communities that were coming up on the market, hadn't yet hit the market. And we were able to lock in a tour and put the deal together and ended up winning the deal. So it worked out pretty well for us. I know that I've sold other assets in that market for far more than we're currently buying this one for. So our confidence that we're getting a good deal is pretty high. So that's kind of exciting. It's 136 units. It's in Fort Worth. It's pretty below market in terms of the in-place rents. I think they're at 90 cents a square foot in place, and we're going to try and target just below $1.15. Although there are other properties on the same street getting $1.24. So we're really confident that our underwriting is a little conservative, but yet still attractive at the same time.
Yeah.
So did you want to add any more about the deal?
Yeah, maybe before Dave, just maybe take us back for a minute or two.
Sure.
Glenn, what's this real estate track record? I obviously know.
You tell them a little bit of the origin story too. It's always kind of cool.
Yeah. So let's take a brief second. I started off as a maintenance man.
Yeah.
And
later in your early 20s.
Yeah, my early 20s, and went into management, a leasing agent, and then a manager, and then a regional manager, and learned the business for about 25 years.
Yeah.
And about 5 or 6 years ago, started buying multifamily as the owner, not just as a property manager.
Yeah.
And bought a lot of them and put together deals just like this with investors, and have been selling them. And gosh, we were up to 4,500 units.
4,500.
Yeah.
All in Texas.
All in Texas. Yeah. So. Except for my very first deal. It was a 44 unit in Puyallup, Washington.
That's right.
That was a long time ago, but that was the very first.
Yeah.
But all the rest have been in Texas, so I feel very comfortable with Texas. And the track record we've gotten, without going into too much detail, on average, on the last 15 deals that we've sold, the investors have all hit 19, 20 IRR, and most of them were in the 30s.
Yeah.
So we've done very well for the investors because of, like the example I shared earlier, the relationships and getting into the deals before the general public is able to do it. So I've had a lot of experience from the maintenance man all the way through. And then Dave and I actually bought a deal together not too long ago down south of Houston. And we worked so well together, we just want to be partners on every deal going forward. So Obsidian Capital company is now it was born, and now he and I are partners in that. I'm going to take the 30 years I have and the wisdom he has and his underwriting skills, and we're going to just merge those two things together.
Yeah, Dave is a killer financial mind. Has a great model that I've been using myself, kind of in between my own model. So on that, why don't you give us a little bit of your background, Dave?
Yeah, so kind of bounce off what Glenn said. I started investing a couple of years ago after I did some stints doing investment banking, and I was on more of the financial side of the corporate world.
Right.
And then I started investing in real estate, smaller side of multifamily, bought a couple 12 units, syndicated a larger 100-unit property. And most of that was on my own, brought in some KPs, raised the money, and we did really well on those deals. I met Glenn, and I have a really analytical financial side of mind. I love the underwriting, the analytics of multifamily. So we clicked really well. he's got so much experience and just a great track record. I had already done several deals on my own, so we wanted to first do a test run. I'd met him at 3 or 4 of these events, and we'd gotten along so well, and just timing worked out where we were able to try out a deal together. It's 160 units in south of Houston, like you mentioned. And it went so well that we just decided, let's, we were talking about it for a while, let's partner on our business going forward. So
and my wife was a big part of that. She's like, that's the kind of guy you need as a partner. I'm like, oh, that's a good idea.
That's a good idea.
So she was with me when we all went out to dinner. And she gave her stamp of approval. And if my wife says he's a good guy, then he's probably a good guy.
Did the wife get the stamp of approval on Cobble Hill?
Yes.
Yeah, exactly. Deals happen as well.
Cool. Well, you guys got quite a pipeline coming up. I know you're working on quite a few deals.
We are.
So definitely maybe some potential partnerships.
Oh yeah. We'd love to keep working with you.
But on that note, let's look into Cobble Hill here. I'll go ahead and share my screen for everyone viewing this so that you can take a look at what we're looking at. Go ahead and take a look at the property overview. Now all of these documents that we'll look at tonight are available on our site for anyone to reference. And so with that being said, this is Cobble Hill Apartments in the Dallas-Fort Worth market in Fort Worth, Texas. And I'll go ahead and let Glenn and David go ahead and jump in and tell us a little bit about this property.
Well, 136 units built in 1983. It's a 2-story, very typical for its vintage, in relatively good shape. Pitched roofs, swimming pool. Like I said earlier, in-place rents are roughly at 90 cents a square foot, and we're going to bring them up to just about $1.15. We're going to do some renovations on the property, so kind of high level. We're at about 1.2 million in renovations, which we're going to do
100% of the unit interiors.
Mostly in the kitchens, though. Fortunately, the seller's already done a lot of flooring and two-tone paint.
Nice.
And he's put in night light fixtures and blinds. So that's something the seller's already done, not on our dime, but he left all the kitchens original.
Nice.
So we'll go in there and we'll upgrade with backsplashes and cabinet fronts and new cabinet fronts and countertops. And same thing with the bathroom. So really, to renovate those units won't be as expensive as the traditional if you have to do the whole entire unit.
Right.
But we're going to get a lot of the rental bumps correct.
Because they're a primary sole owner operator. They don't syndicate deals. They own these on their own, and they're selling pretty much all their assets in Dallas-Fort Worth now. Like Glenn said, this was a 3-property portfolio. We ended up winning the bid on one of the properties. And they don't really push the rents a lot. So a lot of the properties that are on the street in this neighborhood have been renovated and are achieving really high rents now. And this one's just kind of behind that story. They haven't caught up yet. So
a little behind.
Yeah.
And so in terms of the market, obviously amazing growth market. I don't know how much we really need to convince anyone that Dallas-Fort Worth is one of the hottest markets in the country. So,
unfortunately, I've owned 10 other apartment complexes up there in the DFW, and they've all done exceptionally well. Every one of them.
So why don't you guys just touch on kind of your highlights on the market? What gets you excited about the market?
I guess you talk like macro, micro. I'll let you talk a little more macro, but if you're on a micro level, even just down the street, they put in a brand new school, really nice school. If you drive the neighborhoods nearby, there are a lot of nice new homes going in. The apartments are all in really good condition. It's a pretty low crime area, and close to a lot of major employers. And
since 2010, there's been about 500,000 more people that are moving in there, right? So. And it continues to grow at a pretty rapid pace in terms of population and job growth. So all of those really contribute to, impact the housing market there. So,
just great economics. This kind of just touches a little bit more. And of course, these documents are available directly on holdfolio.com, but just touching on some employment growth, employment by sector, the location. Dave was touching on this, the Fort Worth, and kind of micro economic level of this. In terms of rent growth, Glenn, you've seen it, Dave.
I've experienced on all of our deals. the rents have continued to climb, anywhere from 5 as high as I've seen, 10 or 12% on those. So,
and we're budgeting, on a deal level, we're budgeting 2 to 2.5% annual rent growth. So we're below the
historical.
Below the historical, yeah.
Correct.
And I mentioned that earlier when we first started about our conservative underwriting.
Yeah.
Because the last thing we want to do is, overpromise people that they're going to get all these really high rent increases and then us not deliver.
Yeah.
I mean, we would never do that. And I've been around syndicators that have done that.
Yeah, so exactly.
I think that's a little bit of experience coming through that.
Yeah.
So Dave, you were mentioning that the property here is a little behind some of the other ones. So this is kind of a look at the market comps, and of course these details are available again for review.
Sure.
We touched on the business plan here, guys, in terms of going and making these interior renovations, those finishing touches to those kitchens, the cabinet refaces, the backsplashes, all bringing this property up to the kind of standard of properties around it. So it's just a classic value add play.
In addition to that, we're also going to make some improvements on the exterior. So, for example, the monument sign out in the front is probably the weakest one on the whole street. So the ones that are getting great.
It's not attractive, the entrance.
Yeah, correct. And so we want to bring our standard up a little higher there. Also, we're going to do some stuff to the patio balconies. We're going to replace some wood rot. It's
stucco repair.
Some stucco repairs that are just kind of not tremendous, but they're kind of eyesores, right? So if we're going to push the rents, we want to make sure the outside looks good too. And then in addition to that, we're going to put some money in the leasing office too to get new furniture and give it a fresh, modern look. Structurally, it's in great shape. It just looks a little outdated.
The pool deck too.
And
they redid the pool area. We'll be able to update all our marketing on it online and have a much better entrance for people to come into.
I think this might be a good place to touch on the exit strategy of this property.
Sure.
Glenn, maybe what's your perspective?
Well, some of the success that I've had on the other deals that we have up there in DFW is when David and I decide that we're going to sell at a certain sales price, and it's driven by the net operating income. When we hit that mark, whether it's in year 3 or 4 or 5, we will sell and we'll return the investors what they were expecting to get on the exit.
Right.
If for some reason we don't get to that point at 3 or 4 or 5 years, David's lined up a great loan that it's a 12-year note.
That's right.
Right. So then we have the opportunity to either hold on to it and enjoy the cash flow at that point, or we'll just refinance out and return some of the equity to the investors.
Yeah, exactly. Yeah. So we've got a great loan. I mean, to give an overview, we got 4 years interest only. It's a green loan program through Fannie Mae. So our interest rate is very low right now. It's under 4.5%. We haven't rate locked yet, but it's going to be under 4.5%. 12-year loan, 30-year amortization, just great, 80% loan to value. Got a really good loan here.
It's probably good that the rate hasn't locked yet because I saw another 5 basis points.
Did it tick down? Yeah, it did tick down.
Another 5 basis points.
So that's really good.
Feels like everything's in our favor right now.
Yeah, this going. We better rate lock soon.
Yeah, a little different story than I was closing. We were closing on an 80 unit about 6 months ago. And it was in that climate where the rates were going up every 2 to 3 months.
Like, let's do it. Come on, let's go.
Yeah, we were just trying to push it through, and it happened to us actually on our most recent 2 deals where the rate was almost 50 basis points higher.
Wow!
Just in the 90-day due diligence. So
that's crazy.
Good. Yeah, definitely in a good.
And we underwrote it to 4.8 or 4.9 on the rate, so we're going to come in 40, 50 basis points lower than that.
Which will just juice our cash flow.
Which just juices the cash flow even more.
That's a huge swing for sure.
Yeah. And people may have asked, why are we getting an 80% loan to value, right? I mean, that's a pretty good question.
Yeah, I think the basis of that is, on our whole project cost, we're going to be closer to about 70-75% of the total project cost. And we do value add deals. We do deals where we can buy at $9 million and bring the value up to 11, 12, 13 million, right? By putting in some money, managing it better, getting the NOI up. That's our whole goal. So the end value that we're going to bring this up to will actually put the loan closer to around 60% loan to our end value, target value. So as we improve the property, we get safer and safer on the loan to value. And that gives us a buffer in case the market ever does shift or change. We'll always be at a value above where we started.
And
Yeah,
the good
absolutely.
news is we're really starting off pretty well because the appraisal came in, ordered
Couple
by our
$100,000
lender.
more than
Yep, and
Yeah.
it came in higher than our purchase
yeah, it
price.
came in higher than purchase price.
So
So
we're
that's
excited
good.
about that too.
Yeah.
Well, Glenn, I know you have experience with Citygate. Why don't you touch on that experience? Why we're using Citygate here?
Sure. I might even address, I used to own my own management company, and I sold it, not too long ago because I was selling a lot of our apartment complexes, which means that our unit count was going down and down and down. And that was by design, right? We were capitalizing on where the market was heading at the time. And so when I sold that, I had to find who I would want to manage my properties rather than managing it myself, because I've been doing it for 25 years.
Sure.
So Citygate's managing another property that I currently own in Fort Worth, and they are very, very responsive. They actually are managing another deal for the
That's right.
Tim and Tom, who bought one of my deals in Fort Worth.
Yeah.
And
they came very highly recommended at first.
Yep.
And great company.
And because of my experience in property management, I'm able to kind of vet out, the good players and the bad players. I'm pretty happy with where they're at, and they're responsive. So I have a lot of confidence in them. They're based right there in Dallas, and they've probably got about
we have a phenomenal
10 to
regional
15,000.
manager.
Yeah,
you can tell them that's probably important, because as anyone listening, one of the most important parts of running a deal with a third-party management company and improving it is having a good regional manager. These people in the on-site, they matter so much more than you would think. So
the regional manager that's going to be over our asset here, she left my old management company that I sold and came over to Citygate. And, and that gave me a great deal of confidence because she was really good at what she did.
She's really good.
So I feel just thrilled that she's kind of with me on other deals and currently deal on this deal with this
and then she's coming back around and
relationships are important, but so is performance. And she was the one that helped me hit some of those exit prices that I recently sold in Dallas Fort Worth. It was a lot. She had a lot to do with that.
Yeah.
So good.
So Glenn, do you envision owning your own management company again?
Eventually, yes. You have a certain amount of control when you do that, but it all depends on the unit count, really. And I play that kind of, year by year. If the economy is doing well and we're able to secure enough properties, then probably so. But really, I don't want to feel like I have to carry the cost of the management company at the expense. So so there's pros and cons to that question. But having done it for 30 years now, it would be fairly easy for me to self-manage.
And I also noticed the 3% management fee, which I think you can confirm this, but that's a below market.
It's
right there for the relationship, right?
Yeah, I have a relationship and some expertise, and because I've done work with Citygate and they know me and they know how I run my properties, they're willing to discount their management fee, probably because I'm a good owner. We're a good owner, and the experience in the relationship. So you're absolutely right.
Nice. Well, listen, here's a look at the team here. Glenn, myself, Dave, and Sterling unfortunately wasn't able to join us, but I'll go ahead and we offered the opportunity to go ahead and get some questions into us. So I will go ahead and switch over to these questions. I think some of them, some of them we're able to actually address directly, and I think that by now our portfolio group here have a pretty good understanding of Glenn and Dave here and how we met, and it all comes down to the type of people you want to do business with. And I think for Holdfolio, we have a strong foothold in the Midwest, in Indiana, Ohio, and Kentucky. And we love the Midwest, and we'll continue to buy in the Midwest. But we also wanted exposure to a growth market like Texas. And so that's what gets us excited about this partnership, not only on Cobble Hill Apartments, but the potential to continue to leverage these types of relationships as we both continue to grow our companies. So that's exciting. And Glenn, you touched on a little bit in terms of how you found this deal. Maybe just recap again.
Sure. Relationship with a broker that I've done a lot of business with, and out of gratitude for the business I've given him, he gave us first look at this deal, and we capitalized on it. We won the deal mostly through that relationship.
And then David, there's a question regarding the 85-15 split. on the rental income and profit from the sale. I mean, confirm the structure there.
Sure. Yeah, I guess 3 and 4 kind of go together. So we're doing just a straight 85-15 split. It is on all rental income. So cash flow distribution split at 85-15 between sponsorship and investors. And then profits from the sale will be the same. So when the deal sells, we'll first pay down the loan, closing costs, and then the remaining profits will be split 85-15 basis. So why is there no preferred returns? That's a great question. There's so many ways to structure syndications, right? A lot of people do a preferred return. Some people don't do them. Some people have different waterfalls. If you hit 15 IRR, then the split goes from 70-30 to 50-50. So many ways to do it. The reason we structured it like this is because we want to create a really stable company to be able to support these deals. There are a lot of deals nowadays that aren't hitting the 7, 8, 9% preferred return that a lot of people are doing.
Mm-hmm.
And when that happens, it doesn't give our company any cash flow and room to grow and breathe and support these asset managers that are overseeing these deals. So for us to build a good long-term company and properly support these deals, we favored a little more cash flow along the way, aside from doing maybe an 8% preferred return and a 70-30 split on that. And so we gave more to investors on the back end, and without the preferred, it gives us a little higher cash flow along the way. So really, if you look at both scenarios, it comes out to very, very similar returns to doing an 8 pref and a 70-30 split.
Yeah.
And I've exited some deals where on the backside, I would get 50% of the profits.
Right.
Sure.
Well, here, we're not doing that.
We're giving up 85% of the profits in terms of
Investors
more
will
cash
get
flow.
all the additional upside.
Correct.
Yeah.
But we're going to split it kind of equally with them.
Yeah, and we've done without a preferred return on a few of our deals, and I think from our perspective, we always try to make things as simple as possible.
Yeah,
simplicity.
simplicity.
And so the simplicity, not only for the operation side, but also the investor side, the fact that investors get more of the upside. So if we're giving an 8% preferred return, we've got to make money somehow, and so we're going to be taking the upside of the deal.
Correct.
And basically the vast majority of anything over. So that perspective, and I think,
and along the way, like we're projecting this, our goal is always to get as close to or as far above an 8% return,
absolutely.
right? That's normally our company's goal, 8% return, and mid to high teen IRR.
Yeah.
So this does net us those numbers based on projections.
And I think the maybe last thought from me on that is the fact that basically being able to have consistent cash flow for investors and ourselves. So we participate in the cash flow from the first month in the year. We don't have to wait until the third or fourth quarter to start getting cash flow on investments. Conversely, investors have a more consistent cash flow because they're not getting huge amounts in the beginning of the year and then kind of fading off to nothing or smaller returns towards the end. So, anyways, I think certainly it's a win-win all around. Dave, you want to touch on that? Well, you kind of touched on the loan already.
Loan to value. We did talk about that a little bit about how we're a value add player.
Right.
It's not a heavy lift value add, so there's not as much risk in there. But obviously, there's always risks in every project we do. This is real estate.
Absolutely.
Nothing is set in stone. The market does change. We do everything we can up front to be conservative and to make sure that our numbers aren't overly aggressive. We believe pretty strongly that 80% loan to value on this deal is a safe loan. All of our debt service coverage ratios look great going forward. We have a couple of years interest only, which is going to allow us to boost the cash flow in the meantime, boost the NOI.
It's not just a couple of years, we have 4 years.
4 years, which is phenomenal.
Yeah.
So we have a good interest rate coming in, and it's with a really strong lender, Arbor, which you've done 9 or 10 loans with before.
Correct.
So
Fannie loan.
So we have a phenomenal relationship with them.
Yep, for sure.
Yeah. Cool. Well, Glenn, in terms of that preference, we kind of touched on it in terms of maximizing investor returns and just hitting targets. Anything else you wanted to add to that? I guess the other part of this question is, what is the chance of a refi to continue holding?
That's a great question. I think the first preference is to sell it when we hit our NOI number.
Because that's what we plan.
That's our plan. That's our original business plan. So, the chances of doing a refinance is probably 10-15% that things don't go as planned, and then that's a great plan B.
Yeah, especially with a 12-year loan.
Yeah, we have lots of options.
Yeah, certainly that definitely helps offset those type of timelines. And of course, if the property doesn't sell at the end of 5 years, we'll continue to hold it cash flow and look for that
Until there's a
target.
point where
And
we can
David
sell.
said earlier, that's after we've done our rent lift, and at that point, our leverage is a little lower on a percentage, so our cash flow should be doing fairly well. So worst case scenarios are getting great cash on cash returns,
Right, absolutely.
distributed every quarter.
Correct.
Yeah, I think anyone investing in multifamily real estate is not gonna be shy to hear that.
Yeah,
Not gonna be complaining for that. So, in terms of the payouts and the updates, so we'll be making distributions to investors quarterly. Be receiving a quarterly distribution. We'll be making in-depth updates quarterly, so that this will be detailed reports, more of a kind of narrative approach. And then on a monthly basis, they'll be sharing the health of the property, kind of some key performance indicators. And then in terms of Citygate, we touched on. I don't know. I guess one part of this question is will Citygate manage those improvements, Glenn?
That's a great question. So no, I'm very involved. David and I will be very involved. We'll oversee. We have a contractor that we've selected that I've been working with for 10 years.
Mm-hmm.
They kind of know the business plan. They know how to prepare the invoices for the draws, but we're able to get better pricing. And generally, a property management company will generally charge 10%
or more
of the capital to oversee all those projects. Well, that's money we're going to save the investors, and we're going to be very hands-on. So I think the end results tends to be a little better if we just kind of handle that ourselves.
Yeah, that makes sense. And then, so there is, the question here is, it seems like there won't be capital calls, but there are provisions. And so in what situation would a capital call happen? What if an investor doesn't want to participate? So in the scenario that, and we don't anticipate this project having capital calls. If there was a scenario where capital calls would come up, then every investor involved would have to agree to contribute more capital. So if someone did not want to contribute more capital, it simply would not happen. And as managers ourselves, we have the right to go ahead and the responsibility to go ahead and provide potentially a loan to go ahead and get us through any type of cash flow pinch that might come up.
Correct.
So those provisions are in there. And then the deal here, past deals on Holdfolio have funded within a couple of days. Why is this one taking longer? It's a great question. And historically, we've been raising roughly about $1 million for our last few deals. And those that $1 million has been funded within the first 2 to 3 days. And it's actually very similar to Cobble Hill Apartments. It's just we're raising an extra $500,000. So I think the best way is that we've had great response on this. We're at right around $1 million, which is in line with our other projects. And so we expect to continue to fill this out, and I think it's just a factor of where our investor network is right now. And so if you're thinking about this project, I certainly encourage you to get in touch with us. I think probably another week or so at the most until we'll have full subscriptions. So with that, I'll go ahead and switch us over to video. And just get a few fair goodbyes here. Again, Jacob, David Tupin, Glenn Gonzalez. I appreciate you guys taking the time. We're down here in San Diego together, and we thought, I mean, what
it's
a
perfect time.
Yeah.
We're closing in a couple of weeks on Cobble and new partnership with Holdfolio.
Yeah.
We're extremely excited about that. You guys are great guys. We've known you for well over a year now, and been wanting to do this for a while. So
and the total committed we already have is, what's the rental?
We're pretty close. We're over
3.1 million, I think.
Yeah.
We're at, so
roughly 500,000 left on a total project basis.
Yeah.
And I think the way that Glenn and Dave approach deals is very similar to Holdfolio. We're very hands-on, very involved, and so we're looking forward to partnership. And we look forward to anyone out there looking into this deal. Please get in touch with me directly. You can email us at info@holdfolio.com, jacob@holdfolio.com. Any
Ask us
closing?
any questions investors
Yep.
have, always, we welcome questions. I
Yeah,
love
yeah,
hearing
I
the
love
feedback. So
We'll get back to you right away.
We'll get back to you right
just filter them
away.
to us and
and
we'll get you the answers. So,
Yeah,
so
absolutely.
we're really excited.
All right. Well, thank you very
Thank you.
much, everyone.
Cool.
Have a good
Thanks,
one.
guys.
Thanks. That was a
Good
lot
night.
of fun.
Bye.